Target seems to be facing a never-ending nightmare. Since early 2022, its financial performance has been disappointing executives and investors alike, and it's been raising alarms across the entire retail industry. How can one of the biggest American companies sustain itself if sales are falling all across the board, quarter after quarter? In fact, just a few months ago, Target revealed that it faced the first full-year decline in sales in a long time. This means the retail giant has faced acute losses for 4 quarters in a row in 2023, and it's on track for a repeat in 2024 as inflation-weary shoppers cut back on discretionary purchases, which accounts for more than half of Target's merchandise. The retailer is now taking desperate measures to save its business, but that may not be enough to prevent its imminent downfall. The chain continues to close multiple locations using excuses that do not stick anymore. Something far more disturbing is behind Target's woes. That's what we're going to reveal by the end of this video. But before moving on, we kindly ask you to support our work with a thumbs up, and don't forget to subscribe to our channel so you don't miss what's coming next. Target is a barometer of the American consumer. When shoppers are struggling financially, it shows on the retailer's bottom line. In October, the chain reported that in 2023, it faced its first full year of sales declines in 7 years. Between Q1 and Q4, sales dropped by an average of 3.7% per quarter, a very concerning development, considering that in 2022, sales growth was already dismal at just 0.8% year over year. In that year, the company lost money in all 4 quarters, but not mainly due to lower sales volumes. Target was forced to take a profit hit as it slashed prices for thousands of items consumers were simply not interested to buy. The industry titan saw profits dropping by 49% in Q1, 90% in Q2, 54% in Q3, and 52% in Q4. That cost the chain an estimated $8 billion, according to retail experts. Now, CEO Brian Cornell is predicting a sluggish 2024, given that economic conditions have further deteriorated Americans' purchasing power. Target's middle-class customer base has been strained by higher prices over the past couple of years, leading many to pull back on discretionary goods. So far in 2024, Target's sales have declined for 3 straight quarters, hinting that it might end in the red for yet another year. Investors are panicking about the prospect of another unprofitable quarter, and they've been dumping Target stock at an unprecedented rate. The company's shares have dropped by 43% since its peak. The slump was caused by management's failure to improve Target's merchandise mix. Its competitors seem to be far more well-positioned in this aspect. Instead of focusing more on goods highly demanded by consumers, especially food and household essentials, the chain doesn't seem to have learned from past mistakes, and it stocked up on clothing, decor, electronics, toys, party supplies, and other non-essentials in 2024. However, rivals like Walmart and Costco have added more food, more essentials to their stores, snatching an even higher share of the market, while Target lags behind. With 60% of the company's product offering looking less attractive to cautious shoppers, Target must focus on the needs of its customer base if it wants to turn things around. The biggest part of its profits are being driven by a category the company's invested very little on: groceries. Oftentimes, consumers complain about the lack of fruits, the quality of the produce, and the fact that grocery shelves always look understocked. Last year, the retailer also raised food prices far faster than its competitors. From January 2023 to December in the same year, Target's grocery prices went up by 21%, as reported by Go Banking Rates. Meanwhile, Walmart and Costco only raised prices by 10% and 9.4% respectively. And they started to slow the pace of price hikes in October 2023 and through 2024. At the moment, Target's prices are 8.6% higher than Walmart's and almost 14% higher than Costco, according to an analysis by RBC Capital Markets analysts. It's clear now how Target's pricing strategy has backfired. Its main rivals can offer more value and better deals. That's what Americans want right now. Adding to the problem, the company passed on higher operational costs to customers for 3 consecutive years. Even for middle-income families, that may have been a little too much, and the latest numbers are a reflection of this. In a desperate move, the retail giant is now pulling out a number of stops to bring about that turnaround, the most recent of which are price cuts on thousands of items, sparking fears among shareholders it will suffer another big profit hit. The decision to offer deep discounts may not be enough to boost sales and to boost revenue. Other retailers are doing the same as we approach the all-important holiday shopping season, but their products are already cheaper than Target's to start with. Going into the winter, the company faces a tricky balancing act of growing top-line sales through deals and promotions, while also keeping profitability in line with investor expectations. Throughout 2024, the retailer already lowered prices in discretionary categories. Unfortunately, the moves over the past several months have not resulted in people shopping there more often or buying bigger baskets. The company's CEO has attributed this in large part to inflation-weary consumers and stretched household finances. It's quite worrying that the retailer is not doing what it needs to do to climb out of rock bottom. It should be supplying its stores more efficiently, but that's simply not happening, and no one seems to understand why. During the past quarter, Target's customer traffic, which includes online and stores, fell 1.9%. The average amount that customers spent on those visits dropped 1.9% too. Comparable sales, also called same-store sales, tumbled nearly 4%, leaving industry analysts wondering what management is trying to do. Target's performance is significantly worse than the overall market, which underlines that Target is losing market share, said Neil Saunders, managing director of research firm Global Data. All in all, the picture painted by today's figures is of a business that has run out of steam. At this point, the company's CEO, Brian Cornell, is admitting that their customers are hurting from the price increases of 2023. Citing a very challenging external environment, Target on Wednesday posted its third straight quarter of comparable sales declines. For the third quarter, ended October 28th, Target's comparable store sales fell 4.9% due to continued softness in discretionary spending. We are not satisfied with the top-line trends we've been seeing, Cornell said. For the holiday season, Target will continue its focus on non-essential products with thousands of items under $25, he said. The executive announced that the chain reduced prices on about 5,000 items across its stores and website this summer. The retailer already lowered prices on 1,500 products, with the rest to take effect in coming months. On the other hand, a former Target executive that recently left the company did not express much confidence in a strong holiday sales season, saying that he anticipates comparable store sales in a wide range around a mid-single-digit decline for the fourth quarter. Last Thursday, former Target Vice Chairman Gerald Storch warned that holiday spending will likely disappoint this year as inflation-battered consumers run low on savings and scrimp on spending due to geopolitical uncertainties. It's very clear that consumers are running out of money, Storch told Fox Business. They're increasingly stressed by inflation and the exhaustion of their pandemic-era savings. When asked about his expectations for the holiday shopping season this year, Storch was blunt. "I don't expect too much, frankly." To add insult to injury, recent store closings means that less money is coming in. The recent chain announced multiple closings in big cities across California, Washington, Oregon, and New York in September. The news has left many shoppers shocked, especially those who rely on Target for daily essentials. According to Target, the main reason for these closures is organized retail theft. Even with extra security guards and new theft prevention tools, the company says the crime levels in these locations are just too high. In a recent statement, Target explained that despite our efforts, we continue to face fundamental challenges to operating these stores safely and successfully. People living near the stores that are about to close are frustrated. For instance, in the Ravenswood Shopping Center, located on East Palo Alto, California, many residents rely on Target for everything from groceries to pharmacy services. The store was shuttered down September 28th, leaving many locals upset. Local leaders are also concerned. Antonio Lopez, the mayor of East Palo Alto, admitted that the store's closure will hit the community hard. He mentioned that the city is trying to find a replacement store that can offer similar services like a pharmacy, but it's not an easy fix. Meanwhile, Target maintains the narrative that theft is exploding across its stores, and some data from retailers, along with numerous videos of store robberies and looting, seem to support the claim. CEO Brian Cornell said in 2023 that organized retail crime cost the company over $1 billion. That's a whopping sum that could result in more dark storefronts the coming months and put the retailer in dire financial straits. For their part, retail analysts and researchers are questioning the true extent of the problem at Target stores. $1 billion of stolen merchandise a year seem way too extreme when considering local crime statistics. They argue that Target is using retail theft as a useful deflection, camouflaging weak demand, mismanagement, and other issues denting the business. Theft is just one of many structural issues the company is coping with, from inflation to rising costs to the shift to online shopping and overexpansion of brick-and-mortar locations. Target seems to be looking at its own grave, but it's doing whatever it can to keep that a secret. William Blair retail analysts Dylan Carden and Philip Lee said in the report that Target is likely using the opportunity to draw attention away from lower profit margins due to higher promotions and poor inventory planning in recent quarters. They say the chain misjudged how much non-essential merchandise it needed to carry, and now they've got a glut. The analyst noted that overall shrink, merchandise losses due to external and internal theft, damaged products, inventory mismanagement, and other errors makes up just 1.5% to 2% of the company's sales. That percentage has remained steady for years. The truth is that Target's recent store closures may be due more to the underperformance of poorly managed locations. Local crime statistics also raise questions about Target's rationale. One analysis by journalist Judd Legum at Popular Information found that the stores Target is closing in both New York and San Francisco had lower reported theft rates compared to other nearby locations. The William Blair analyst said, "We believe companies like Target could indeed be using the current narrative around shrink to take broader action in lagging parts of their business. We have to acknowledge potentially ulterior, more opportunistic motives. Target could be using shrink to mask other issues and is closing stores to boost overall margins." The company seems to be cracking from within, and nothing is being done to effectively reverse the situation. If it fails to address its growing issues, the worst may be yet to come for Target. Will poor management cause the death of this beloved retailer? 24 months of losses is a lot for any company, but for a multi-billion-dollar corporation, the risk of disaster is even bigger. We honestly would hate to see this iconic retailer going under, but if its inability to adapt to market trends is an indication of where the company is headed, it's pretty evident that things will not end well for Target. What are your views? We'd love to read your comments. Please write them under this video, and thank you very much for watching.